Thank God it is Friday. 30 minutes until the start of trading. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Are we watching a great rotation? Small caps beat the S&P 500 for 10 consecutive sessions.
And a power play, President Trump wants tech giants to pay for the electricity used by energy-hungry data centers.
Plus, President Trump's credit card threats rained back on this week's bank earnings parade, but we still could end up apparently getting a Trump card from the banks.
You mean like a literal Trump card?
Like, I think Hassett said we could get a Trump card, and I don't know if, I guess that would mean it's a 10% APR, so I'm applying for that.
Built has one of those apparently, which I am a holder of, so we'll see what happens there. By the way, I am looking at the memory chip stocks this morning because they have been on a tear. SanDisk, I think, already is up like 70% so far this year. By far leading all the gains. There's no specific news, but Matt, it continues to be the same thing. There's a lot of demand, not a lot of supply, so they have pricing power, and it's getting expensive.
Yeah, so no rotation out.
Correct.
Of those stocks. HP, Hewlett-Packard, was cut to sell by Barclays and CFRA as memory cost inflation that was reflected by those stock prices material impacts this company's stock price, and its margins is really the problem, right? So HP shares down 2.5% in the pre-market.
Yeah, what's good for the memory chip stocks is bad for a lot of the hardware players. By the way, TSMC CFO told Bloomberg that the demand in capital expenditure for AI will only grow in the coming years.
In the next 3 years, the total capex is going to be significantly higher than the number in the past 3 years. So that is evidence of our strong conviction in the AI megatrend.
Let's discuss with Bloomberg Intelligence hardware analyst Woo-Jin Ho. Woo-Jin, can we start with what Matt was talking about? What this means for HP, maybe even Apple, but for hardware, how much of a headache is it that these memory chip makers have gotten so expensive?
It's a huge headache, quite frankly. If we think back a quarter ago, we knew that there were some supply chain constraints, especially on the memory side, and companies have started taking down numbers. But the prices continue to rise. Memory is supply constraint at least through 2026 and into 2027, and the hardware makers are having a tough time keeping up.
What does this mean then for valuations, Woo-Jin, of the hyperscalers? Because the chips are obviously incredibly expensive. I guess the leases are probably getting expensive. The electricity, if you can even find it, is very expensive. I know revenues grew really fast at OpenAI in a very short period of time, but are they eclipsing or getting even close to the costs?
Yeah, so if we think about the CapEx projections, I think it's going to be roughly about $800 billion for this year by the hyperscalers, and then you have to tack on whatever the neo clouds as well as the sovereigns are going to add. Quite frankly, those guys have already booked and they have the CapEx plans in place. If anything, they're probably going to eat some of that cost, but they're also going to ask the hardware players as well as the hardware vendors for the most part to take on some of that cost. And the server margins in general have been fairly low in the mid-single digits.
All right, Woo-Jin, thanks very much for joining us this morning. Woo-Jin Ho there from Bloomberg Intelligence. And speaking of rising costs, today the Trump administration and governors of Northeast states will announce an emergency wholesale auction to get tech companies, to pay for the electricity used to power AI and to try and, I guess, offset some of the cost increases that we've already seen on consumer electric bills. Let's get details from Bloomberg senior editor Mike Shepard in Washington. And Mike, you're in a perfect area to hear from people who are seeing bills double or even triple already. Those costs aren't coming back, are they?
Well, that's a great question. Will the costs get peeled back? And we have seen them rise. Just in September, they were up 7.4% overall for retail. And from the start of last year through August, they were up 10.5% for residential customers. And that is the biggest increase that we have seen in years. So consumers and, yes, voters are really feeling the pinch of what is happening in the AI boom. all these data centers that are being built are coming with not only the benefits economically that the president and the administration and the tech companies are advertising and talking about, but they are bringing a cost, and that is the rising price of electricity. And so this step today by the administration, together with governors from both Republican and Democratic states, is seeking to address that by forcing this emergency auction. And Matt, what's interesting is that this auction is different than some of the other emergency auctions that grid operators periodically hold. In this case, the grid operator in question, PJM Interconnection LLC, they would do this on a 15-year basis. And the idea is to raise a lot more money for new power generation.
Yeah, I was just talking with my parents this morning, Shep, who are in Virginia, and they said that they figure their bills have at least doubled for electricity. So it's a problem, and it's a problem for voters, and it's been reflected in those early elections we had, hence the Trump administration concentrates on it. We're going to get more for Trump when it comes to housing affordability. In Davos, Hassett was talking, saying we might get something on 401ks, waiving tax penalties to pull out in order to buy houses. Shep, just how big of an event is this speech going to be from Trump at Davos?
Well, it will be very closely watched. You know, naturally, anytime the president goes to Davos to meet with the global financiers and other elite bankers, it is something that, you know, especially our audience pays close attention to. But because he is trying to address the affordability issue here in the U.S. there as well, even without perhaps acknowledging the affordability word itself, it's one that he has derided publicly in events at the White House over the past several weeks. And yet, at the same time, his administration is really trying to take a series of steps. Look at the cap on credit card fees. And yes, what he will be talking about regarding housing at Davos. So people will be taking very careful note of what he says there, and including on the effort perhaps to try to rein in corporate purchases of residential real estate as well. So there are a lot of steps that may be taken by the administration that we'll be looking for him to talk about there as well, not just on electricity today, but on housing and then other issues as well. He's also talked about steps to try to rein in the increasing cost of energy overall, and they have reported progress, of course, with reduced gasoline prices. But let's see what he says next week in Switzerland.
It's going to be a busy one. Shep, thank you very much. Bloomberg's Michael Shepard. Elsewhere, the regional banks are having their moment in the sun. PNC, Regional Financial, M&T Bank, and State Street all reported this morning. The results paint, yes, a positive outlook, but only PNC is gaining this morning, up 3.7%. The rest are falling. Joining us for more is Herman Chan, banks analyst for Bloomberg Intelligence. Herman, what have you made of the regional bank results so far?
Yeah, mixed trends all around. You mentioned PNC up in today's trading session. Really strong results and good guidance for 2026. Really outpaced analysts' expectations for lending and net interest income. On the other hand, regions disappointed a bit on their net interest income guide. So mixed trends all around.
What are we expecting still to come? We've had these, almost all the major banks. Mm-hmm. We're getting a lot of the regional banks. I know that my beloved Huntington Bank in the great state of Ohio is coming out next week, I think Thursday.
That's right.
So what are we expecting to come still?
Right. So we have a really good operating backdrop for the regional banks. We're seeing improving net interest income, some margin expansion, growing the balance sheet. We're seeing some acceleration in loan growth. Deposit trends look good. And credit's really stable. So despite some of the economic uncertainties and potential issues surrounding unemployment, the banks are talking about really stable consumer trends. So we'd expect that to continue.
When it comes to these regional banks, though, because it has been so mixed, does that kind of pretend to more M&A, considering the sector has already had a lot between the haves and have-nots?
That's right. We'd expect consolidation to continue. It's an ongoing theme for the industry. We've got over 4,000 banks in the United States. I'd argue we don't need that many. And there's a really good regulatory backdrop where the administration's approving bank deals at a much faster clip. That's really reduced the uncertainty with bank M&A, and the bank stocks have been holding in there. So there's a lot of positives.
I mean, holding in there even with all the credit card drama, I have to say, which was supposed to overshadow everything, but did it really?
I'm looking, by the way, I'm on NerdWallet right now.
Okay.
And I'm looking for the lowest possible APR. I'm seeing 16.9. I think that's the lowest I see here.
Right.
And Bilt's coming out with a 10% one.
You keep saying that, but I'm wondering what you're talking about. Bilt?
It's a credit card. It's a credit card that you can use to pay your rent and pay your mortgage. I don't mean to buzz market them,
yes,
and then you get points for them.
I get it. Okay, I was just wondering, but I'm talking about like a real credit card, like the Sapphire card or the Platinum card.
Right.
Like these are not coming down to 10%, right?
They won't come
will
down
a
to
Trump
10%.
card? Will a Trump card be something like useful, or will it be a Bilt?
Well, we'll see.
Bill's about to like write us some very angry messages.
I'm obviously,
It's good marketing for them, I'll tell you that. But we'll see how the Trump card eventually plays out. If we're talking about a 10% introductory
it has
rate,
to be that, right? Because
right.
he said if it's not, like legally, if it's not 10% interest, by Tuesday,
right.
These credit card issuers will be in violation of the law. That's what the President of the United States said.
Violation of the law is a bit strong, so there needs to be some congressional actions to really make that into law, in our view. But 10%, right? Banks already are offering introductory APRs that are below that, so I don't think that's anything extraordinary. But if it's 10% in perpetuity, then that could be something that the banks really rally behind and potentially look at a bit more aggressively.
All right, it's a fantastic story, obviously, because it's important to investors, it's important to Wall Street and the banks, it's important to consumers. So anyone can connect to this story, and we'll continue to cover it. Herman Chan will continue to cover it for us from Bloomberg Intelligence. Quick check on what's going on in futures this morning. We have a rally. Well, we have gains, I should say, in futures on the S&P, about 0.2%. NASDAQ futures up much higher, about 0.5%, because of the big memory chip movers that we saw. You were highlighting these companies that were up 60, 70%. Last year. The biggest gainers on the S&P 500 are the biggest gainer last year, are the biggest gainers today.
Yeah, and that's for all this like rotation that's supposed to happen. And yeah, sure, it's happened to start the year with the small caps outperforming. But will it really last, or is it just a broadening out? Some of the other movers on our radar this morning, J.B. Hunt, they reported quarterly revenue after the bell yesterday. They missed estimates. There's some real weakness in freight demand, especially intercontinental, just not much demand and a lot of supply.
Walmart promoted its chief e-commerce officer to U.S. CEO ahead of Doug McMillon's departure as overall CEO.
And why don't you take this one, Matt?
Oh, man. Porsche deliveries for the whole year down 10% last year. It's the worst since the great financial crisis for the 911 maker. The problem is weak demand for electric vehicles, in which they had invested so heavily, a slump in China, and the fact that because they invested so heavily in like electric 718s and Macans, they didn't make the gas ones that people wanted.
Right.
So now there's a supply shortage.
But shares are not off that much, is just because, they've been crushed recently.
They're down, 10% this week.
Right.
They're down 50% since the IPO. Double-digit drops every year since the company came out with its shares. You would have thought this is a slam dunk watching like Ferrari and Tesla at the time, but absolutely a horrible investment. Yeah,
Barkin recently just said the only things powering the economy are AI and rich, so you think if you're a luxury company, you could grab onto that.
The problem is nobody drives a GT3. You just buy it to flip it. Coming up, we're going to head back to Motown, Detroit. We give you my conversation with Ford Executive Chairman Bill Ford. I just saw him standing on the sidelines of a little conference there, and I snagged him. I said, "Hey, Bill, come over here."
Good work, Matt.
And he did.
That's journalism.
This is Bloomberg Open Interest. That's next. It's getting out of high interest. Look what's making headlines around the world. Norway is reeling after Nobel Peace Prize winner Maria Corina Machado handed her medal to President Trump. Norwegian politicians called the move unheard of, meaningless, and damaging to the prize's credibility. The Nobel Committee says medals cannot be transferred, while critics warn the episode underscores how politicized the Peace Prize has become, and it may just have made them rethink their decision to give it to her. President Trump plans to unveil a proposal that would allow Americans to tap some of their 401k savings for a home down payment. National Economic Council Director Kevin Hassett says the plan, to be announced at the World Economic Forum in Davos, could let buyers convert part of their home equity back into their retirement accounts. The move targets high housing costs ahead of the midterm elections. And Ford is in talks with China's BYD to supply batteries for hybrid vehicles built at Ford's overseas plants. The hybrids would be shipped worldwide, including back here to the U.S., although most hybrids sold domestically would still be built in North America. The discussions have triggered political backlash in Washington, with lawmakers warning Ford against deeper reliance on Chinese suppliers. Most of these lawmakers maybe didn't already know that Ford works with BYD now on other cooperations. And speaking of Ford, it's been a busy week for the automaker with the Detroit Auto Show and a visit from President Trump. I discussed Trump's tariff and manufacturing policies with the executive chairman, Bill Ford.
We're adding jobs even as we're sitting here today. So we're growing as a company. Our market share is growing. Our products are incredibly well received. But I'll say this. The government, and I've been saying this for years, and thankfully people are paying attention now, we were in danger of losing our industrial base as a country. And what we found out during COVID, I think what the world found out, is when we started making respirators and ventilators, which other companies could only make a few a month, and we could make 1,000 a month. They realized that there are companies that can make a lot of things, there are companies that can make complex things, but there are very few companies that can make a lot of complex things, and we do. We integrate software into hardware. We turn out an F-150 every 53 seconds out of our Rouge plant. And, and there are very, very few companies anywhere in the world that can do that. And so I'm very happy that our government, not just the administration, but actually Congress as well, has realized that that really matters.
One of the things that we've heard about this administration is, regardless of what you think about their policy, they pick up the phone when you call. And I know that Jamison Greer is meeting some people in Ohio tomorrow. Yep. Are you going to be going there? And
I'm not, because we're right in the middle of the auto show. But yes, we'll have our people there. I mean, this is a crazy week. We've got the Detroit Auto Show, and tomorrow's the big opening of that, which I will be at. Today's Ford Racing. As you mentioned, we had the president 2 days ago. So, yeah, it's quite a week for us. But, yeah, Jamison Greer and others from the administration will be touring our Ohio Assembly, and I think that's great.
The reason I ask is that Jim Farley always says this is the most American car maker that there is. And yet some of your competitors may be getting an advantage if they build their products in South Korea, for example, or in Japan, because then they only pay a flat 15% tariff. Can you work with the administration so that Ford doesn't get hit harder than others that are building out of the country?
Yes, we are. And I also think this. We were the most American before there were ever tariffs, or anybody even thought about tariffs. Well, why is that? Because we paid a penalty versus the companies that were building in Mexico and elsewhere and bringing them in. But it's part of who we are. I feel very proud of what my family is. I'm only the fourth family member to be at the head of this company. And to me, building in America was something that I always wanted to do. And even when some of our executives would say, we shouldn't do that, we should move more jobs overseas, I always said, no, we're going to build here, and we're going to build in our hometown of Detroit, Michigan, and in Michigan, but we're going to build elsewhere in America. And as I say, that was something that was important to me, even though we paid a price for it, and that was long before anybody ever talked about tariffs.
That was part of my conversation with Ford Executive Chairman Bill Ford. He is, of course, not only the Executive Chairman, but the scion of the Ford family. There are many Fords. But I think they have always felt they bear a certain responsibility with regards to not only the U.S. economy. Remember, Henry Ford created essentially this manufacturing economy, this consumer economy we have, because he said, I'm going to pay my workers $5 a day so that they can afford to buy a car.
Right.
The kind of car that they're building, And nowadays, I think there are a lot of workers who would struggle to buy a new car.
How does that, though, contrast with if they feel sort of this obligation to America and the American economy, the BYD story of using their batteries abroad?
But this is, exactly. This is overseas, right? And I mean, I think.
But don't some of them get shipped back to the U.S., though?
I imagine. I mean, I only know what I've read in Keith Naughton's reporting, but as far as he says, some of them will get shipped back to the U.S., though most will still be built in North America. But you want, in a free market capitalist system, people to choose the best competitors from a supply chain. Otherwise, you know, American automakers for a long time rested on their laurels, and the products got much worse. So I don't know. I think it's also interesting that, did you ever make a sartorial decision that you instantly regretted?
I have, and I think I know where you're going with this.
I should not have worn those pants. I got them for Christmas.
How many emails did you get?
I got a lot of
text
commentary,
emails,
and at first it was like, cool jacket, because it was just the shot of like waist up, and then they pulled out, and people were like, oh, that was not good.
But you looked excellent.
In fact, our producer, Will Shaker, his mom wrote in and said, Matt's jacket might look good in person, but on TV it looks like he's wearing a garbage bag over Santa pants, which...
That is harsh. That is a harsh statement, but Matt, you do you.
I'm probably not going to do that again, but it was fun for the day, and it felt right in Detroit. Coming up next, Alpine Saxon Woods' Sarah Hunt says geopolitical concerns are distracting investors from the real risk, which is earnings growth. We'll talk to her about that next. This is Open Interest.
Five minutes ago into the start of cash equity trading. So much for that rotation. Sure, everything is up, but it is tech that is outperforming, up 0.5%, the Russell up 0.1%. It had outperformed the S&P for the past 10 consecutive days, a very long stretch, the longest since the 1990s. But it's memory chip stocks now, Matt, that are outperforming along with tech. So that rotation at least on hold for today.
Right, and the memory stocks were the big winners of 2025. We have less than 4 minutes to go until the opening bell. Sarah Hunt of Alpine Saxon Woods joins us as the trading day gets underway. This is Bloomberg Open Interest. We are moments away from the start of trading on this Friday. The Bloomberg Open Interest program kicking off with green across the screen. S&P futures up 0.2%. NASDAQ futures up 0.6 as tech stocks really come back. The TSMC announcement, I think, took a while to set in yesterday. And now with the downgrade of HP over at CFRA, because memory chips are so expensive, investors are like, memory chips are expensive, but people are buying them, so I'm going to buy those stocks again. TechCrate ringing the opening bell at the New York Stock Exchange. Happy campers because the stock has more than doubled since they went public in October. They do some kind of cybersecurity thing. They need to hook up with Porsche because they had cybersecurity problems apparently with the Macan and the 718. Aladdin, I guess, cast members ringing the opening bell at the NASDAQ.
I have a couple thoughts.
I haven't seen it.
They must be so cold.
Well, I mean, it's probably heated at the NASDAQ market site.
Good point. But two, I don't know if viewers can see, but the genie's head has sparkles on it, and it's breathtaking. It's gorgeous.
It looks like he came in late from Scores, you know? But
all right, anyway, shall we move on to the markets?
Yeah.
I'm looking at what you mentioned, Matt, the memory chip stocks. There's no specific story today, but it's just the momentum continues. They're on a tear. They already led the S&P 500 in 2025. SanDisk is up, I think it's something like 74% so far year to date. It's in the 70s, that I know. Micron over the past year is up more than 200%. These things are unstoppable. They have pricing power, and that's given them leverage over the AI supply chain, Matt.
Yeah, absolutely. I'm looking at, wow, year to date, and keep in mind, it's January 16th.
Yeah.
Year to date, SanDisk shares are up 81.3%.
Crazy.
So, ripping face.
Yeah.
As they say on the floor. HP was cut to a sell by CFRA as memory cost inflation materially impacts the company's margins. So there's the other side of that coin right there. Small caps are benefiting the most from the broadening AI trader. They have been year to date, ex SanDisk. You can see here the Russell 2000 in white pulling ahead of the NASDAQ in blue and the S&P 500 in yellow. So it looks like that rotation happened to some extent over the past 10 or so trading days. Let's bring in Alpine Saxon Woods Chief Market Strategist Sarah Hunt. And before we get to the costs and benefits of memory chips. Just the small cap rally, I mean, it's been going on since Liberation Day, really.
Yes, it has. And I think the anticipation is that anything that is better for the U.S. economy and or keeps some of the competition out of the U.S. economy is going to help the small cap stocks. And I think that you've also seen that they've reacted very positively to rate cuts. So the question is now going to be what happens with the Fed going forward this year. But I think it's been a positive. It's been a trade that people talked about for several years, and when it finally started working, even though it had a couple of fits and starts a couple of years ago, I think it's continued to work.
I say one of the facets of the rotation actually goes back to what Matt was talking about of the companies that are suffering because of memory costs. I mean, HP certainly not one of the big tech stocks, but Microsoft a little bit weaker, Alphabet having some issues. Basically, any of these companies that have to buy memory chip stocks, Apple too, because all of a sudden costs are more. How big of a theme is this? Is it just some individual stocks, or is it something in AI really is going to start to get more dispersed, and not everybody's going to get a winner because of the prices?
I think you're going to see different places have bottlenecks, and I don't know that, I mean, I was just looking at the SanDisk to see how much was short, because that's a stock you don't want to be short in the last couple of weeks,
Yes.
right? But I think that there will be places where you get bottlenecks that people weren't necessarily anticipating them ahead of time, and then I think that you'll get reactions to those. I don't think that this is going to be a pervasive issue for memory forever, because like everything else, when you start to get prices moving like that, people start to react to that and they start to change things. I think that this is going to be a continuous move as the CapEx build out keeps going of where the places are where there's small shortages and or issues. And there will be moments when other companies don't perform as well because all of a sudden they just had a whole increase in prices that they weren't expecting. But I don't think it's going to stay pervasive.
How much of that CapEx build out still needs to be funded? Because we're looking at record bond sales, right, to fund that. And I know that these companies have market caps far larger than the bond sales we're talking about, but still, like, the costs are so high on the chip side, on the electricity side. I imagine the building, construction, there's no labor, there's no land. And I know the revenues have come on fast, but they haven't met nearly the level of cost. Like, what if there's, Farrah was asking on surveillance this morning, what if there's a funding shortage for an open AI? What kind of effects does that have in the entire ecosystem?
Well, I think there's some specific issues with OpenAI in terms of the funding they need versus the spending that they've promised. I think with a lot of other companies, there is an ability to raise that money. I mean, we haven't even talked about the ancillary issues and the fact that now there's a discussion on the policy front of saying, okay, Microsoft, build your own build your own energy for your data centers, as opposed to having problems with electricity prices across the grid. So there are a lot of things that have to happen, but I do believe that you are seeing some use cases that are making people excited enough to think that they will happen. And like everything else where the extrapolation is forever, you're never going to go in a completely straight line. And I think that there will be breakthroughs on the power usage front, on the cooling front, like all the places where people are really worried about bottlenecks going forward, which has energy generation and cooling and all this and a lot of the ancillary issues. You're going to see technology iterations that make that incrementally better. When they happen and when those dislocations occur, I don't know. But it's sort of like the reason where people don't want to get 100% in one thing because they're worried that if there's a change, they may need to shift. But I think that there is ample funding in some places and problems in other places for funding. We just have to see how that plays out.
I would love to get your thoughts on housing too. And I realize that this literally just came out, so I don't expect you to have like a well thought out thesis. But Kevin Hassett saying that President Trump's going to make an announcement in Davos about 401ks. The idea likely is that you can withdraw from your 401k without a tax penalty if you're using that to invest in a house. And Trump making a lot of pushes for housing affordability. For one, I saw that and I was like, oh, that can't be good for stocks if everyone can all of a sudden liquidate 401ks. But on the other side of things, it just helps to represent stimulus and more purchasing power for consumers. With all of these proposals, how do you view them for risk assets? Is it more firepower or is it risks to liquidating 401ks and inflation?
I think it's less about the risk of liquidating 401ks. I mean, I think that wealth creation in this country, a lot of it does have to do with the housing market. And the fact that that's now out of reach for a lot of people is a problem. Creating more demand may not be the only issue. I mean, I think that we've all talked about the demand and the supply issue. I think that from a regulatory standpoint, you have a lot of restrictions to build in places where people want to live. So can you streamline that to some degree? Because Post the financial crisis, once rates went down, housing prices went up. Rates came up. They did not come down commensurately. And that used to be the tradition that held. So as rates went up and mortgage costs went higher, the purchase price of housing went down. It didn't really do that this time. And you can argue all sorts of reasons why. The whole issue about whether or not Blackstone should be able to purchase homes, it's a small part of the market. But a lot of markets like that are on the margin. So if somebody's in there as a buyer of last resort on the margin, you're not going to get those drops that make it easier. So I don't know how to fix the affordability issue. Fixing some of the I can get a down payment issue is helpful for people who are close.
Right.
But there are a lot of people that aren't even close. And I think that's the biggest issue that they're trying to contend with. And I'm not sure what the answer is, but it's a number of things. It's not one thing.
By the way, there is not a loud, but a quiet debate about whether or not there really is an affordability issue, right? Because we have seen inflation, but also, at least the Economist argues that wages have kept pace with inflation and indeed are rising faster than inflation. Housing costs, sure, if you live in New York, apparently the mortgage tax and fees in New York will cost you about 90% of the average economy, right? But in Columbus, it's like 30%, and everywhere else outside of like New York and San Francisco.
Well, I think this is a question that is also very tied to, are we creating jobs in places that are outside of the coastal places where we spend time? And if you're creating jobs, then the housing there is going to be, people are looking for housing where they live and where they work. But it's not so much a problem of houses that are a lot cheaper in certain parts of the country, but wages are not as high as they are in other parts. And I think to me, it is a lot to do with the fact that you didn't see that drop in prices that went up with mortgage costs that you usually see an ebb and flow with that. And that is one of the biggest problems, because it makes it more difficult for someone to, if I don't change the price of a house, the mortgage rates went from 2% to 6%, all of a sudden that's much more expensive than it was for the exact same house with the exact same price. Yep. So I think that is the issue. And I don't know that wages have moved fast enough to counteract that.
Sarah, we're going to have to end it there. Thank you so much for joining us. Enjoy the rest of your Friday and your weekend. That is Sarah Hunt from Alpine Saxon Woods. About 10 minutes into your trading day, a look at this equity market that is rallying. Breath is not so good. Only 150 stocks are moving higher, despite the overall index is heading higher. And that's because tech is doing well today. The rotation having a little bit of a fit, not a start this morning. NVIDIA, Broadcom, Micron, Microsoft, Tesla, Meta, so all the big tech players, a lot of those memory chip stocks like Micron having a very, very good day. To the downside, some of those energy companies aren't doing well. Again, we're expecting some sort of auction today with the president and with regional governors. I guess all governors are regional. With governors to auction off energy to the big tech giants to force them to pay. So Constellation Energy is down. Vistra is down. Walmart, those shares are down about 1%. They've made some new announcements changing up their executives. So if you look at the sectors, you're going to see utilities at the bottom of the pile because of those energy-related stocks. Utilities down 1.4%, followed closely behind by materials, down 0.75%. And again, it's information technology that's up at the top. Again, Matt, it's NVIDIA. If that's up, that sector is going to be up, and it's all the memory chip stocks, too.
Yeah, absolutely. We're going to talk about those memory chips on a tear when we come back. Their pricing power is a threat to customers from Apple to HP. We'll get the take from our leader of technology research. I was going to say Mandeep Singh, but also Carmen Reinecke is going to join us from Bloomberg News. They're both leaders in their own right. This is Bloomberg Open Interest.
Let's see what the sell side says this morning. Time for your top calls. First up, Morgan Stanley downgrading Kraft Heinz to a sell. They're warning that intensifying price competition, heavier promotions, and accelerating private label momentum will pressure U.S. food companies into the new year. Shares down 2.5%. Next up, BNP Paribas. They are cutting Molson Coors to a sell. They say that the company's profit outlook is getting worse and is now expected to lag peers for the next several years. The firm sees little reason to expect a turnaround, reflecting a broadly cautious stance on U.S. alcohol company shares down nearly 2%. Finally, HP hit with back-to-back downgrades, concerns mounting over structural weakness and rising costs. Barclays has cut the stock to a sell. They cite long-term challenges in PC, a harsh memory cycle, and no clear catalyst this year. CFRA said anemic growth and unprecedented memory cost inflation will pressure margins. Matt?
All right. let's discuss that story further with Bloomberg Equities reporter Carmen Reinecke, because, Carmen, these memory chip makers have had fantastic margins. Investors have noticed they bid the stocks up more than any other sector, really, in the S&P, if memory chips were a sector, last year, and they're killing it. I mean, SanDisk is up 80% already year to date, and we're only 10 trading days into the year.
Yeah, it's true. These stocks have really been the leaders. They were at the top of the leaderboard at the end of 2025, SanDisk, Western Digital, Micron, Seagate, and they've continued to rally in 2026. I think the thing we're seeing, though, so while these memory prices are good for this kind of company, the ones, making the digital storage here, it's bad on the flip side for the buyers of those things. So that's where we're seeing a hit for HP. It also could affect Apple down the road. And basically the issue is that those companies are going to either have to take a hit to margins, to offset these higher prices, or they're going to have to raise their own costs, which could hurt the demand that they're seeing for their own products. So it's really interesting how we're seeing the AI trade sort of boom in different parts of the market, and how it's, kind of creating potentially a new order of winners and losers.
Carmen, memory is usually seen as a commodity with boom and bust cycles. Does the prevalence of AI and the demand for it just completely reshape that idea of how prices behave?
That's a great question. I don't know if it will completely shape that idea. There are sectors of the market that are cyclical, but what I have heard from investors is that the cyclicality is much less prevalent here, and people are expecting that it won't be quite as cyclical because there is so much CapEx flowing to these areas of the market. And, we need more compute, we need more data centers, we need all of these things that will benefit memory storage stocks for maybe longer than a normal cycle would be. So there is definitely a shifting dynamic, at least in the short term. Long term, we'll see. I think we could definitely see some of that cyclicality come back. But for now, the boom seems to just continue for this sector of the market.
Carmen, thank you very much for your thoughts this morning. That's Bloomberg's Carmen Reinecke. Coming up, we're going to dive deeper into the small cap rally with David Royal, Thrivent Chief Financial and Investment Officer, who has an ETF that targets just that. He's going to join us next. This is Bloomberg. Even after yesterday's AI-fueled rally, it is small caps that are leading this equity market. The Russell 2000 has outpaced its bigger counterpart for a 10th straight session. Thrivent also getting in the action. It's recently converted its mid-cap value fund and core small-cap value fund into ETFs. Joining us now is the man behind that, David Royal, Thrivent Chief Financial and Investment Officer. Thrivent manages more than $193 billion in assets. David, great to see you this morning.
Thanks for joining. Great to be here again.
Perfect timing, but I know that this isn't a matter of trying to time the market. Why do you see a trade in small caps and mid caps as sustainable? Why would this ETF be attractive now?
It's not just valuation, although they're relatively cheap. I've noticed small caps seem to be behaving a little bit differently than they have in the past. It used to be you kind of needed a strong pro-cyclical economy for small caps to rally. They've been behaving pretty well on days where we've seen some economic weakness. So I think they're behaving in a little more rate-sensitive fashion than they have in the past. And with a couple, probably 2 more Fed rate cuts this year, I think that could benefit small caps.
Well, I want to ask just quickly about the conversion. I used to sit in a lot on the ETF IQ show, and we did see a lot of mutual fund conversions. Is that just because it makes them easier for people to access? Or is it a more tax-efficient wrapper? Why do you like the ETF?
It's certainly more tax-efficient. What we never want to do, we're a fundamental bottom-up equity shop. And what we never want to do is have an advisor who wants the alpha we can deliver and we don't offer it in the right package. So for a managed account portfolio, the ETF has certainly tax advantage. You also have intraday liquidity, too.
So on this idea of continuing the small cap trade, how important is it that we get those rate cuts? Because earlier in the week, Matt and I were talking about I believe it was JP Morgan, Michael Feroli and the team there, a new call from them that we're not going to get rate cuts this year. And in fact, the next move will be a rate hike in 2027. What does that do to the sector if that's how it plays
And that's
out?
certainly not the consensus view, but
Sure.
I think small caps would struggle if we don't get a couple of rate cuts. We're going to have a new Fed chair for the June meeting appointed in May. And so I think small caps probably do need a couple of rate cuts to rally, but I think we're going to get them.
Sure.
We've seen some pretty significant weakness on the employment front. I think that's what's going to keep rate cuts in play.
By the way, I don't just randomly yell out the word shark. Although that would be an interesting.
That would be cool if you did.
Interesting tick. No, Shark Ninja. I want to get to some of the stocks that you like specifically because you always bring a few names to us. And I have an analyst friend who's obsessed with this stock. And he says they spend more than twice as much on R&D as any other competitor. So it's not just that he likes, the margins and the fact that they're getting consumers to buy their stuff, but also that he thinks they have good products.
Yeah, I try to bring you some interesting names. We're overweight NVIDIA too. A lot of people come and talk to you about NVIDIA. So the theme for these stocks is the upper end consumers doing better than the lower end consumers. So upscale brands, but still the upper end consumers trading down, looking for value. We also want brands that compete on product innovation or product niche as opposed to relying on macro tailwinds, because we have seen some weakness in employment. So Shark Ninja would be an example. They compete with Dysons of the world at a little lower price point. I remember dropping my kids off at college, and there was a Dyson cooling fan and a Shark Ninja cooling fan right next to each other. I saw 6 straight parents go and buy the Shark Ninja fan because it was about $50 cheaper.
Yeah, I've done that with like a hair blow dryer that is much cheaper, and it's like exactly the same as a Shark Ninja.
You probably never noticed, but you have a Shark Ninja cooling fan in the makeup room here.
Really? Yeah. Wow. Okay, we are fully supporting Shark Ninja apparently. But just on this theme of the consumer, I would love to get.
The stock has tripled in the last 5 years.
Yeah, it's done very well.
So it's not just us, right?
And really, the past couple of months, it's up 30 or so percent. Yeah.
Well, on the consumer, Michael Hartnett of Bank of America had his note out this morning, and his trade that he wants to put on, which is definitely not necessarily contrarian, but the degree of it is contrarian. His idea is to not just underweight mega cap tech, but to flat out go short it and to go long the consumer. And part of it is just about the labor market is holding up. The other part is an affordability push by the administration. Obviously, you have some consumer names. Shark Ninja, Boot Barn, I think, was in there too. What do you think of that call?
I agree with it directionally. We're still overweight big cap tech as we have been for a number of years, but we're talking about making some trades to probably reduce that overweight. I think we'll still be overweight large growth, but I like that trade into the consumer. I think there's value there. I do think that a lot of the economic and government factors you talked about will help the consumer stocks.
What's up with Boot Barn? Why do you like this stock? I know we're looking at 1 year up 22%.
So they have a great product niche. It's a smaller niche, so they're not going to get out competed by the Amazons of the world. There's a big denim revival. I don't know if it's driven by Yellowstone, but my wife and I have certainly been watching Yellowstone.
Actually, Dani literally just earlier this week was telling me she loves to wear a Canadian tuxedo.
Love a Canadian tuxedo.
And about half the brand, almost half the brands they sell are house brands. So they're not offered elsewhere. So you worry less about them getting out competed by an Amazon.
So, with these picks, I imagine you're not that worried about the U.S. consumer. But so much talk about the K-shaped economy, and surely these products are for people right in the middle of that K.
Yeah, and the reason I'm not overly worried about the U.S. consumer is that real wages are still positive. They've been positive on a year-over-year basis since June of 2023. And despite consumer sentiment being weak, as long as real wages are positive, the consumer can spend, and when the consumer can spend, they always do.
Yeah. They're not going to get $2,000 checks and then save that money.
No.
Right?
Well, okay, then if you look at other policies like, this one likely to be announced from the president, that 401ks that you're going to be able to liquidate, not have a tax penalty, and then you can go and you can buy housing with it, and that's why you would not get that penalty. Does that just amplify the consumer trade? What does it do?
I think it does. And there's going to be bigger tax refunds this year because of the tax law changes. So I do think it amplifies the consumer trade.
You get bigger tax refunds, you can sell your 401k without penalties, and you're going to get a $2,000 stimmy check from the tariffs.
And you're just going to go buy Shark Ninja.
But inflation's going to be fine.
And boots.
Don't worry about inflation.
And boots, yeah.
David Royal, great having you on the program. David Royal there of Thrive, and hope you come back soon. Coming up in the next hour, Monetta's Aoifinn Devitt joins us on set to explain why she's most concerned about private credit hiccups. The cockroaches may come back. And Vicky Peacey discusses her firm's copper deal with Amazon. The metals have been hot. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Equities now a little change, but still tech outperforms.
Yeah, coming up, hardware companies like HP are not part of that outperformance, under pressure as prices skyrocket from memory chips.
And interestingly, SanDisk has turned around this morning. Elsewhere, as President Trump moves to make tech giants pay for surging power costs, we're going to discuss the AI boom with Vicky Peacey of Resolution Copper.
And President Trump may unveil a plan next week that will allow people to take money out of their 401k plans, not borrowing against them, but actually selling the assets and using the cash to pay for buying new homes, pay for down payments.
That all to come in his Davos speech next week. But we begin with the great rotation showing no signs of slowing. Sarah Hunt of Alpine Saxon Woods weighed in on the small cap rally.
The anticipation is that anything that is better for the U.S. economy and or keeps some of the competition out of the U.S. economy is going to help the small cap stocks. And I think that you've also seen that they've reacted very positively to rate cuts. So the question is now going to be what happens with the Fed going forward this year. But I think it's been a positive. It's been a trade that people talked about for several years. And when it finally started working, even though it had a couple of fits and starts a couple of years ago, I think it's continued to work.
Joining us now is Aoifinn Devitt, Global Wealth Managing Director at Moneta. And it's, perfect timing, right? Because even we see now the Dow and the S&P turn negative. The Russell 2000 is still, barely, but still in the green, and it's been killing it year to date. So is this the new trade? Is this proof that what we were trying so many times in the last couple of years is finally going to work?
The rotation trade, in terms of, I would agree with your previous guest, which is say that definitely the trade rhetoric is better for small cap. But I think what is often not realized is that small cap equities often will have a very divergent performance based on whether they're dependent on tariffs. Some are dependent on trade. We hear about the winners supplying into the tech value chain. What we don't often hear about are those that are just basically on the sidelines, no longer able to make ends meet. So it's a very mixed picture in small cap. And I'd say from our perspective at Moneta, investors are still quite reticent about entering small cap.
By the way, when you hear rotation trade, what do you think about right away? Because I didn't really think of the small caps. I thought of like the S&P 493, or when I hear broadening out, I think of, the equal weight versus the S&P. And that also has outperformed, but it's got to be, I think you still want quality. And I know that term is so broad and overused, but do you agree?
Absolutely, we agree. At Moneta, we've always had a quality bias. We've always had a very broad diversification across the cap spectrum, as well as internationally, I'd say as well. We don't just focus on US stocks. We've always thought that it makes a lot of sense to play that global game. So we have been a big part of that. And there is rotation out of the Mag 7 and out of the top tech names, primarily because we've seen these headlines suggesting that this cannot be sustained.
One of the other sectors that I know you've been looking at that especially today is very interesting is energy. A lot of the big energy names are falling. President Trump in maybe moments time is doing this energy auction, trying to get big tech players to pay for the rising costs. How do you think about a sector where clearly demand is there, but there is a lot of politics weighing on it?
The interesting part about energy and the commodity price is that there actually hasn't been that much of a linkage between commodity prices and the price of the underlying shares and how they performed. Sometimes they're linking, but sometimes they're not. What we say about energy is this is the classic picks and shovels trade. So we want to be looking at energy as really an adjacent trade to owning that tech. So when it comes to energy, we've seen clean energy do quite well last year, oil do less well because of the pricing. It is ultimately more sensitive to geopolitical headlines than another sector, but it will be at its root demand-supply based.
Are you worried about inflation this year, Aoifinn, because we are getting more tax refunds apparently than we have in quite a while? Homeowners or prospective homeowners may be able to cash out their 401ks. President Trump has talked about giving $2,000 stimulus checks. He's raising money with tariffs, making goods more expensive, and then taking that money he's raised and giving it to consumers to go back and buy those goods. It seems like the perfect recipe for inflation.
I completely agree with you. I am worried about inflation. We've talked about this just this week, the economy being run red hot and how that might just be all right. If it goes red hot, there's no pushback to that necessarily. All of those pointers will stimulate the economy. What I'm concerned about is there's a focus on the inflation number that is now heading closer to 2%, not only here, but also worldwide. But we're not focused on the cumulative effect of the inflation that we've experienced up to now. And we've talked about the transmission effect when it comes to inflation, to tariffs, to interest rates. The transmission effect of inflation is slower than we think because companies hold back on raising prices. They absorb their excess inventory. They don't push through that cumulative effect of some of that supply chain-based inflation. I think that is still to come. And consumers themselves, I've also stocked up in inventory. They are also experiencing the pain. Not one consumer I speak to across the spectrum is not experiencing real sticker shock at the moment. So no matter what the numbers say, the pain is real.
But why do companies then have such good margins? This is the thing that's been so confusing. If they are absorbing some of these prices, is it just that consumers are still willing to pay more, that they have raised prices somewhere? And estimates, I should say, are expected that margins will get even better this year.
It's a great point. Where does the margin come from? And I would say it's US companies that have really stood out versus their global counterparts when it comes to margins. My take on why margins are where they are is because they've been so successful at cost cutting or pushing cost essentially down the line, kicking that can down the road. They have been celebrated for that. Their stocks have been rewarded for cost cutting, and CEOs now know that that is the way to get their stock price increased is through advertising quite obvious stocks.
Well, just look at Wall Street, right? I mean, we have had a resurgence in IPOs. M&A is coming back. Bond issuance has been at a record. Trading revenue has been at a record, in 2025, and yet they fired more people than they have since 2016.
By the way, Brian Moynihan on the Bank of America call yesterday saying that because of the AI and the tech advancements they're doing, it saved them 2,000 people. That's the number that they've picked.
So that's amazing. He's actually quantifying the productivity gains of AI, and we haven't heard many CEOs do that. Do you think even we're going to start hearing more of that? Because that's what we've been waiting for, right?
What we have not seen yet is actually tracing some of the spending on AI to job cuts. What we've known is they haven't been spending. There has been a transfer essentially from labor to capital. That's where CapEx has been high and labor spending has been low. There have been delayed hirings, but we don't know that that necessarily means that AI is replacing labor. It's interesting to have that number point on it. I'd say that is a very vague number, perhaps pulled out of the air, and that we will see other numbers that are equally vague because it's impossible at this point to actually attribute the substitution effect.
Even before you go, I'd love to get your thought on this credit market. In the public market, corporate bond spreads continue to fall. They're at their tightest since 2007. Does that concern you? Are there potentially more hiccups either in the public bond market or private?
It's an excellent point. What we've seen at Moneta is that fixed income volatility has been significantly muted recently. That has been one management of one sector that this administration has done very effectively because they know that when the bond market gets spooked, that's bad news for everyone. So we perhaps think the bond market is a little too complacent at this stage, that's why we're focused on private credit. That's where we see the cracks appearing. It's a less transparent sector, but we do think there has been a rush to do deals. It's over $3 trillion in assets now. Clearly, corners have been cut and due diligence has been scaled back. So that's where we've seen the so-called cockroaches that Jamie Dimon mentioned. We know there are more of them. They just aren't being focused on yet. And that's where we will see the first signs of a crack.
Yeah, I'm surprised Jamie Dimon didn't talk about it more on the call, but maybe he's ready to put that behind him.
Because we were only asking him about credit cards.
Yeah, that is actually a good point. Credit cards still all
and Fed independence.
And Fed independence, two very important things. Hey, Aoifinn, thank you so much for joining us. Great to see you in person. Please come back again soon. Aoifinn Devitt of Moneta. Let's get a check on your equity markets because gains, they fell, and now we're kind of higher again. One of the weird things has just been what the memory chip stocks have done today. Matt, they've been insanely volatile. SanDisk, I think, at one point was up like 6%. Then it started to fall. I think it's back up at 1%. But here's the net effect of that, of the rotation. Maybe you don't want to call it a rotation.
A little bit of shoppiness. Well, no, but, you can call it a rotation. I just think of broadening out maybe a different thing because I'm thinking of the S&P. Well, and when you say a rotation is happening, people are buying small caps, and you look at the Russell 2000, and half of that index is unprofitable?
Yeah, true. It's not the highest of quality. But I guess rotation means that you sell tech, and we're not really doing that. We're just buying everything. Hence broadening out. We want to get some of the single stock movers at this hour. Shares of HP are falling after downgrades at CFRA and Barclays. The CFRA analyst points to the company's anemic growth and also rising memory costs. We had some earnings from JB Hunt. They reported a quarterly revenue miss. It's underscoring the weakness in freight demand.
Chasing that long white line. Keeping an eye on Fannie and Freddie shares there, extending losses right now down 9%.
Painful.
As we await a speech from President Trump in Davos. Maybe he's going to allow people to cash out of their 401ks.
This market has a real feeling of jumpiness today. You notice that? I feel like there's just a single name stock volatility. Way too much coffee. It's a Friday. They're just trying to get through the day.
Coming up, Porsche sales fell the most since 2009. That's the most since the great financial crisis. What's going on? with the Stuttgart Zuffenhausen 911 builder. We'll talk about that next. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. Canada and China have struck a sweeping trade truce, signaling a sharp pivot away from alignment with President Trump's trade agenda. Prime Minister Mark Carney says Beijing will slash tariffs on Canadian canola, while Canada cuts duties on Chinese electric vehicles and opens its market to them. The deal also restores travel access and marks a major thaw after years of frozen relations. Meanwhile, President Trump plans to unveil a proposal that would allow Americans to tap some of their 401k savings for a home down payment. National Economic Council Director Kevin Hassett says the plan, to be announced at the World Economic Forum in Davos, could let buyers convert part of their home equity back into their retirement accounts. We'll hear more of the mechanics of this, but we hope we will, but it targets obviously the high cost of housing ahead of the midterm elections. And Porsche posted its biggest sales slump in 16 years, with deliveries down 10% overall last year, weaker EV demand, and 26% collapse in China led to the decline, while the supply gaps from focusing too much on EVs and not the products that consumers actually want hurt sales numbers, as well as EU regulations somehow on cybersecurity, Dani. Some of their cars were like a cybersecurity threat to the EU, so they just couldn't sell them. It's a pretty shocking story, but they have a new CEO to try and turn this ship around. Let's get more with Bloomberg Auto's editor Stefan Nicola in Berlin. Well, normally he's in Berlin. I'm not sure exactly where Stefan is right now. But Stefan, we haven't seen this for years. In fact, I'm so used to calling Porsche the most profitable automaker in the world that it's doubly shocking to me. Are investors confident they'll be able to turn this around in the next year or two?
Well, Porsche, of course, as you said, Matt, over the past 2 decades has had lots of years of strong growth, lots of years of profitability. The past 2 years have been rough for them, especially in China, where its rivals are taking market share. Its EVs aren't selling too well. Of course, there are still great products. The 911 still has a lot of profitability. So I think that's what investors will be hoping for, that products like the 911, like the Macan, like the Cayenne, will help bolster profitability and sales in the coming years.
Stefan, what's going on with this EU cybersecurity regulation thing? Why is that impacting Porsche?
Yeah, as far as we know, that's sort of a new regulation that is a bit more stringent than the ones that preceded it. And some of Porsche's cars, as the 718 among them, are built on sort of older software platforms that just aren't meeting these new kind of regulation. And it's a bit too expensive to update these cars. So that's why some of their production had to be stopped, and that hurt sales. I think future models obviously will adhere to this new regulation, so that's something that Porsche will want to put behind it really fast.
I had a viewer writing in about the jump from the 992.1 GT3 to the 992.2 GT3. He said it's a $60,000 increase in MSRP for the same car with no real changes. Is Porsche recovering enough of what it's lost on its EV investments with its incredible surge in pricing?
Well, what Porsche is trying to do is they want to increase the sales of customized cars. So drivers that, really want to tailor their vehicles to really fit them. And that is really what also drives some of the average price increases. The 911 is relatively stable in price. That's been doing really well last year. But of course, inflation is prevalent everywhere, including at Porsche. It's going to be a big test for how Porsche will compete in China, where prices are under pressure. So, the future pricing there will be interesting to see.
Stefan, how much of this is Porsche Porsche versus others. You mentioned that prices are rising everywhere. What about other luxury vehicle manufacturers? How separate, how much better, or how much in line are they doing compared to the company?
Yeah, it depends on the region, of course. In China, I think pretty much everyone that has a Western nameplate is struggling. Mercedes is, BMW is, Audi is. So I think that that's basically across the board. Porsche is relatively stable in the US, where it has increased sales in recent years, thanks in part to the 911, but also the Cayenne. So I think it's sort of a mixed picture. What's clear is that you know that some of the Chinese market share losses may not come back. So other markets like the US are important, but also a return to more sales in its home market, Germany, where you know, deliveries have been down quite a lot last year. So lots of homework for the new CEO. In 2026.
You know, there's a big argument made for residual values. When I was a kid, Porsche would say, like, we care a lot about how much you can sell this car for after you enjoy it for a few years. And we've seen those collapse on the electric side, right? With certainly with the Taycan, which is a fantastic vehicle. But you know, you pay $150 for it out the door, and then a year later, it's going for 40, 50% less. What does Porsche plan to do about that? Do they just restrict production?
Well, I think one part of the equation is certainly they have backtracked a bit on full EVs. You know, they're aware of the problem. They're pivoting more toward hybrids. But I think they're also just going to try to build very, very good EVs. The new Cayenne is coming out soon, the electric version. I think in some markets it's already on sale. They'll have to see how that performs in terms of selling
it's
the
been
fully electric
slated
version
online,
versus
Stefan. As you know, I'm sure
yes.
Online commentators are like, why don't I just buy a Chinese vehicle if I'm going to buy this?
Right. Well, you know, the Chinese have multiple good offerings, affordable prices, but of course Porsche is Porsche. You know, diehard fans are all over the world, and that's what the company will try to bank on in the coming years.
All right, Stefan, great to get some time with you. Really appreciate it. Stefan Nicola runs our autos coverage out of Berlin, talking to us about Porsche. Those shares since they've IPO'd, down about 49%. So they've been absolutely crushed. Here's a 5-year look at Porsche shares. Sticking with cars, I spoke with Oracle Red Bull racing driver and 4-time world champion Max Verstappen in Detroit on his career goals and challenges in the past season.
Take it race by race, to be honest. You know, we had a bit of a tough, first half with some good moments and some bad moments, and a bit of a tough start, but. Second half was a lot more enjoyable. Also on the team side, you start to feel more comfortable, confident when things are going well. Of course, even in the second half, we had a few tough races, but overall, way more competitive. And I think it's always nicer to end the season like that.
I also asked him if he was still friends with Lando.
I saw that. It was
because you told me to ask him that.
And he was like,
And that was like end of interview. He was like, get this off me, and
Okay, but to be fair, they are really good friends, but they had such a heated season. It's a fair
That's what
question.
I said. I thought it was a fair question too. But I'll tell you what, that guy has focus.
It's literally racing, and that is it.
Yeah.
Anything else is not in his purview. Matt, the president is speaking right now. I just want to bring some of the headlines from it. He's speaking at a roundtable on rural health, and this is specifically the one I want to mention. He said on Kevin Hassett that he's good on TV, but wants to keep him where he is. I feel like that suggests that there's only one Kevin left in the running, just Kevin Warsh, if he wants to keep Kevin Hassett where he is.
I mean, I would say the same thing, but I don't know if you can take this kind of comment on face value, because he's also told us at least 3 times in the last 2 months that he knows who he's choosing for Fed chair. And then Scott Bessent will come on later and say we've still got more people to interview, and so.
Yeah, but how about this? How about this headline from him? Fed officials don't talk much, and Hassett's good at talking. I don't know. I mean, he's at least leaning away from him. I think that's fair to say.
I can't imagine in central banking any group of officials that talks more than our Federal Reserve. I mean, there's 3 Fed speakers on the docket today.
Maybe Trump wants the Fed speaker
Fed officials talk
less.
constantly. We'll continue to monitor these comments for any headlines, and you can watch the full event yourself if you'd like on the Bloomberg terminal. Just type LIVE GO. This is Bloomberg.
Because they spent hundreds of billions of dollars, and we're going to have that money spent to the people and given to the people, not we're going to circumvent the insurance.
Let's get a check on the markets right now. Coming up, we're looking at very little change on the S&P. NASDAQ 100 also very little changed. The Russell 2000 is outperforming again. I almost said let's get a check on the markets and then skip straight to the T's. Without a check on the markets. But we got it. We got it.
Because they're doing weird things. They're turning around. They were up a lot. Memory chip stocks aren't doing as well as they were before. A very jumpy market.
Now I'll do it. Coming up, Amazon strikes a deal with Rio Tinto for Arizona-made copper. We'll speak with Vicky, Peacey, president of Resolution Copper, next. This is Bloomberg Open Interest.
Amazon is striking a deal with Rio Tinto to become the first customer for its copper using a new bio-leading technology. Joining us now, I'm pleased to say, is Vicky Peacey, Resolution Copper president. Resolution Copper is operating that copper mine in Arizona, and is a joint venture between Rio Tinto and BHP. Vicky, thank you so much for joining us.
Thank you, Dani. Thank you, Matt, for having me on. Really excited.
And congratulations on this. Just what are the details? How did this come about, and how do you expect it to function?
Yeah, so we just did an investment in a old mine called Johnson Camp in southern Arizona in Cochise County. Rio Tinto is, Newton is the name of the technology, and it's a Rio Tinto venture. It is decades in the making of a lot of investment. But what it does is it really cracks the code on copper sulfide leaching. It uses naturally occurring bacteria that occur simultaneously with copper mineralization, and we just make the environment right to get more copper out. So we're bringing on new copper supply from an existing old resource, and the most interesting thing is we're able to do it from 0 to 18 months to make first copper cathode in December of 2025.
How has the sustainability picture changed behind mining, especially copper mining? Has it improved substantially?
Oh, absolutely. I mean, the United States has a gold standard of regulations. Mining companies are very, very responsible. Shareholders and stakeholders obviously demand that we produce copper in a way that is responsible and that society demands of us. That's probably one of the big reasons why we have the deal with Amazon on Newton, because we can produce copper with much less footprint, far less water, and low carbon. So it's very attractive.
And copper is becoming just so much more exponentially important for this new economy, for Amazons of the world, these hyperscalers that are investing so much into AI. Your copper is coming from Arizona. How big of an issue is it to have more demand and to maybe not have enough U.S. supply? Can we solve that picture with the global supply chain as it is now?
Well, the United States has the copper resources, so yes, we can solve that. I mean, we have Resolution Copper is just up the, couple of hours away from the Johnson Camp mine. It is the second largest undeveloped copper mine in the world, 2 billion tons, approximately 1.5% copper. It's a fabulous resource in the footprint of an existing mine. We have the resources here. We just need to have the courage and the care to invest in them, to build them, to bring them online, to permit them. It can provide 25% of the U.S. demand for copper. So we can, we've been at a decades-long copper deficit in this country, but we can actually solve it.
And that deficit obviously has led to the prices that we're seeing, record highs for copper prices. As someone who's getting that stuff out of the ground and selling it, I'm sure you like to see that high price, but as someone who's reducing the deficit, do you think that we can bring prices down and make them more stable in the future?
Well, ultimately, there's some factors that are driving that, but it is the fact that we don't have enough new mines coming online to meet the demand. And it is exacerbated by, globally, whether it's Indonesia or the Democratic Republic of Congo, Panama, Chile, there have been mine production disruptions, and it has an outsized impact, right, which further creates a problem. And that's really the consumer, right, that ultimately pays the price. And so we need more supply to come on, keep the prices down. And the things that we enjoy, yes, there's AI, but also the business as usual, right? We buy washers and dryers and freezers and air conditioners. We use them in our daily lives, so they should be affordable.
Well, what does the regulatory and permitting backdrop look like? Have those bottlenecks eased at all with this administration, who's been very vocal in trying to make sure we have minerals and rare earth metals, what have you, coming from the U.S., or are there's still points of friction there?
I think the administration has rightly recognized that we have been at this chronic deficit, and so earlier in 2025 they listed copper as a critical mineral, so they really recognize the strategic importance of this mineral. Copper is obviously used in everything that we, from AI to defense to the washers, the dryers, even electric vehicles, but we have to bring on new supply. And this administration obviously recognizes that and has been very supportive.
So the permitting regulation basically hasn't caught up yet.
They've done a number of, by recognizing copper is critical. The thing that's really, they've made a number of modifications to the federal permitting to reduce the regulatory burden so that these projects can go faster. I think what's also helpful is the Supreme Court had a landmark ruling called 7 County, and it really provides far more clarity and speed in the judicial process, which is often where these projects get caught up.
I mean, this administration has pledged to reduce regulation, and this will be obviously a test case for how good they are at that. You've got, as you said, this partnership with Amazon, or a contract with Amazon to sell a lot of your future supply to that company. It gives them a steady source, but also gives you a steady source of income. And what kind of employment do you think we'll be looking at if you get this up and running in full swing? How many Americans are going to be able to feed their families because of this mine?
This is what I like talking about. This is the why. So for Resolution Copper, we have 400 employees today, just keeping the lights on. 4,000 employees right at full production, $1 billion into Arizona's economy for 60 years and potentially longer. So this is a region where there is double-digit unemployment, as high as 80%. So these jobs are really meaningful. It keeps families at home, keeps families together, and we will have generations of miners working at our mine.
All right, Vicky, great having you on the program. Thanks so much for joining us, and I hope you come back when we get a little bit more forward movement on all that you have to wade through to get this mine built. Vicky Peacey there of Resolution Copper. Let's get a check now on what's going on in, well, the stock market. There's absolutely nothing going on in terms of the S&P 500. But you can see the 2-year yield jumping after President Trump says he wants to keep Kevin Hassett where he is. He says Fed members don't talk enough, and he thinks Kevin is...
Well, it's...
Wait, is Kevin very good at talking?
Yes, so this is...
So wouldn't he be great on the Fed?
No, this is the whole thing. It's like, you're so good at your job, you can't get the promotion. Here's exactly what the president said at this roundtable. I want to keep you where you are if you want to know the truth. Kevin Hassett is so good. I'm saying, wait a minute, if I move these Fed guys, certainly the one we have now, they don't talk so much. It's a serious concern to me. So I think thinks Powell doesn't talk much.
And he wants someone who talks more.
No, he wants someone who talks not a lot.
Oh, less.
And so he thinks Kevin Hassett talks too much, / is very good at talking, so wants to keep him at the NEC because he's so good at that job.
All right.
And I guess he's a dovish pick, hence you get the 2-year yield going up. Some of the single stock movers that we are looking at, PNC, they reported better than expected fourth quarter revenue, financing, and deal making specifically among middle market customers accelerated, so those shares are up 3%.
Walmart has appointed new heads for its 3 main divisions, setting the stage for a new generation of leadership before the incoming top boss takes the reins in a couple of weeks. So Walmart, well, they're not doing much at all.
Correct. A lot of things are reversing, though. We're also watching hardware companies. They have been doing really poorly and then doing a little bit better. HP was down more than 2%. Now it's only down 0.1%. There have been some downgrades, some concerns about pressure from rising memory costs. Here, there's also volatility. Micron's still up today, but SanDisk at one point was also up more than 5% today. It now falls 0.8%, Matt.
Coming up, we're going to get more on... You never knew that you wanted so much on memory chip makers. Well, we're going to give you more. Antoine Chkaiban, New Street Technology Infrastructure Analyst, joins us next on the incredible rise of SanDisk. This is Bloomberg Open Interest. This is Open Interest. You're looking live at the Principal Room. Coming up, an interview with FTC Chair Andrew Ferguson. That's at 11:30 a.m. New York time. This is Bloomberg. Memory chip stocks are posing a threat to their customers through price controls. Analysts are downgrading stocks like HP. As a result, let's discuss with New Street research analyst Antoine Chkaiban, who has been writing about this issue. So, Antoine, the memory chip makers have fantastic margins, and it looks like one of the reasons is they're just charging so much that it's hurting the margins at their customers. How important is this to them?
I mean, memory is a very important part of tech infrastructure. This high bandwidth memory is in structural undersupply right now, with demand running well over capacity. And it's critical to run these models because the model weights, don't fit inside the logic part of the chip. And so you need to add very high bandwidth memory. And it's in very tight supply right now. You have, gross margins that have been expanding a lot, that are going to approach, 70% this year. I think, we're getting to a point where margin expansion cannot go, much further. If you look at expectations, actually, they're actually starting to reflect that. So, as we move towards 2027, I'm wondering, after all these revisions that we've seen already, if there's still, much room for further upside.
Antoine, are you thinking differently just about the memory chip cycle with all of this, with the demand coming from AI, what's usually a boom and bust? Do you anticipate something different this time around?
So the cycle may last longer than it lasted in the past, but our conviction is that memory remains, a cyclical business. I don't see any reason why memory would no longer be cyclical. You have, at the end of the day, you have multiple vendors who are, making these DRAM dies and who are packaging them into high bandwidth memory. And at some point, if they add capacity, there is always a risk that you end up in an overcapacity scenario, as we have, in the past multiple times. And so now we're just saying that we're a bit concerned, looking at the multiples that these memory stocks are trading on. We're not, calling for like a massive pullback or anything. We're just seeing better investment opportunities elsewhere.
So where are the much better investment opportunities, Antoine?
I mean, there's TSMC, of course. I imagine you followed the print yesterday. Very reassuring print. We think they're going to continue, to beat and raise throughout the year. We think they're in a very strong position, almost monopolistic. You don't really have many other foundries who can manufacture leading-edge dies today. And then, elsewhere in the supply chain, you have NVIDIA, Broadcom, AMD, and others. Amongst all of them, we really like AMD because we think that they're very much exposed to share gains, with the transformative deal that they've signed with OpenAI. We think that the company can do extremely well and beat expectations in coming years.
On the hardware side of things, Antoine, HP has been a stock that's been beat up a lot for concerns about how much they're going to be paying. Are there hardware makers that would have more access to memory chips, that they would have an easier time as these bottlenecks present themselves?
I mean, I think they can pass on some of the cost, some of the additional memory costs. They can pass on some of it to the end customer at the end of the day. Like if you look at today, like in a chip, like a chip that NVIDIA sells at $40,000, it actually costs them $10,000, and memory is maybe $6,000 out of that for like a Blackwell chip. And the memory and the GPU is of course not the entire cost of a server, right? So there is plenty of room, to take this. If this $6,000 becomes, even $10,000, at the scale of the server, you can pass on some of the cost to your customer.
I want to get back to the OpenAI comment because they feel dominant right now, and the revenue has like eye-popping growth at a speed that's unprecedented. But what if? Or do you see any chance that OpenAI, that ChatGPT becomes like the Friendster or MySpace of chatbots? As Google Gemini and others gain in use.
There is, of course, that risk, Matt. I think if you look at the share gains, of Gemini lately, it's very, very impressive. But let's keep in mind that these models have always been, in a very, in a race, very close to each other. Now Google is able to release, Gemini at a very large scale. They benefit from a very strong integration vertically. Google has their own chips. I think that helps them bring to market like a model that's competitive, that can probably do a lot of reasoning with like a competitive cost per token. Now, I think the proof remains in the pudding. OpenAI still has a majority of monthly active users, and I don't think we can call victory just yet for Google.
Would Siri integration with Gemini change that, Antoine?
That's indeed a very important point that you're making here. I think winning Apple is probably a very important data point. To know who's going to end up winning. Now, we don't really know that much about the relationship between Apple and Gemini. We don't know exactly to what extent they're going to use it, for how long, whether at some point Apple is going to go back to using its own models. We know that in the past, Apple, for example, was working with OpenAI, so everything still could change.
Antoine, thank you so much for your time. Such an interesting sector you cover, and continuing to be even more interesting. New Street analyst Antoine Chkaiban. Happening right now, President Trump is speaking at a roundtable on rural health at the White House, talking a lot more than just about rural health, and it is impacting markets. Earlier, he was saying that Kevin Hassett of the NEC is very good at speaking on TV, and so good, he doesn't want him to go to the Fed because apparently they don't speak much at the Fed. So you see the two-year yield spike, as does the dollar. The dollar erases losses, but also helping the dollar too, Matt, was this a comment from President Trump saying, reiterating the need for Greenland for national security, but saying that there might be tariffs if countries don't go along on Greenland.
Interesting. So, for example, if the EU or if NATO companies fought back, he would raise tariffs.
Yeah, and presumably that's who would fight back, right? It'd be Denmark saying, no, you can't take Greenland, this isn't okay. So I guess it is a direct threat to Europe, and the euro falling to the day's lows after those comments.
The question is, and he's reiterating on healthcare that he would pay money directly to people. This has become, this theme of sort of helicopter money for whatever's not affordable has become a popular one. I'm still waiting to see if he comes out with stimmy checks from the tariffs we already have on. It would be interesting if he agreed to pay people in Greenland a lot more, right? Because there's only like 60,000. So if he pays them,
was it $100,000?
It was $100,000, but he could easily go to 500 grand, right? And it would be affordable considering what they probably have in the ground. And it's hard to say no to $500,000.
Yeah, I guess what would be cheaper for the U.S. sending that, or just amping up tariffs? What's better, the carrot or the stick? Trump using both of them to try to get his way when it comes to Greenland.
All right, we continue to monitor this. Is it a speech? Is it a presentation? Roundtable. Doesn't look very round from here, but we'll continue to monitor President Trump, bring you any headlines that you need. You can watch it yourself if you want on your Bloomberg terminal. Just type LIVE GO. This is Bloomberg Open Interest.
Rid of the middlemen. How long have you heard doctors, all these doctors over there, look so smart? They're all brilliant people. I assume you're brilliant, otherwise you wouldn't be here, right? I assume we have the best. Do we have the best of the doctors, I would imagine, right? Hey, how cool is the White House?
Happy Friday. Let's get you set up for what's ahead on markets next week. On Monday, U.S. markets are closed for Martin Luther King Jr. Day, which I'm sure a lot of you are happy about because this feels like the longest start to the year ever. Plus, the World Economic Forum will be kicking off in Davos. On Tuesday, we're on watch for a potential Supreme Court ruling on tariffs. Plus, it's President Trump's self-imposed credit card cap deadline. We're also going to get earnings from United Airlines and Netflix. Plus, on Wednesday, another round of Supreme Court decisions rolling out, and President Trump will be speaking in Davos. Thursday, we're going to get jobless claims and earnings from Intel. And by the way, every Friday, Bloomberg's Nathan Dean breaks down the key events in Washington, how policy is shaping industries and companies, and the catalyst investors need to watch for. Nathan joins us now. Nathan, thank you for wearing your vest for Matt Miller. I know that was a requirement, apparently, to have you on for longer. Talk about catalysts. Next week, it's going to be crazy. It feels like there's so many potential landmines. Can we talk about President Trump's speech? This idea that we're going to get more on housing affordability, specifically when it comes to 401ks. Nathan, how are you thinking about potential policy coming from this White House?
Yeah, so, we're going to see this in a speech at Davos, and President Trump sort of floated the idea this morning that one of those ideas is that Americans would be able to use 401k money to withdraw it, to then put it back into as a down payment for their home, and then potentially take 10% of their home's equity and put it back into the 401k. Now, we have to see the language on that executive order. What we should note is that a lot of these changes need to be codified by Congress. So if you ever read the language of an executive order that President Trump puts out there, look for the language that he will work with Congress, because then, just you note, he doesn't have the authority to do it on his own. Similar to what we saw when he floated this idea of corporations being banned from purchasing single-family homes, and a lot of the other executive orders / statements we saw this week on affordability. However, what I will say is that you're going to see a lot of headline risk, I think, next week, because not only do we have the affordability, debate / speech at Davos, we also have this credit card interest cap deadline of January 20th.
Yeah, what is going to happen? I mean, President Trump says any credit card issuers charging more than 10% APR after January 20th will be in violation of the law. Does that imply he's going to issue an executive order sometime within the next 4 days?
So we actually gamed this out this morning with a couple of clients, and one of the things we thought of was, look, we're not aware of what law he's referring to. I mean, the president can't just declare and say, look, you're breaking the law here. Specifically, if the CFPB were operating, they could look into this, but the CFPB largely has been marginalized by the Trump White House. So what we think will happen is that you'll probably see a statement coming out saying, look, these companies are now breaking the law, and you're going to see a headline risk in remarks to the reaction to that. But really, this is a story of the bully pulpit. I mean, this is a story to get industry behavior to change just by using this threat or this idea that something is going to happen. We saw Built, just announced that they were going to have a credit card that's capped at 10%. But for this idea, what we're telling our clients is, look, you need legislation to do this. There is legislation out there that would propose to do this. It's somewhat bipartisan, but it's not going to pass. Speaker Johnson even said himself just this week, that, this idea of capping credit card interest is not a thing that he would ever be interested in doing.
Okay, you have all that, and then you have a potential ruling on IEPA. Nathan, it's a whole lot to keep straight, and we're so lucky we have you to do that. If we do get this ruling, do you think it will be treated by corporations in the market as game-changing if it's found illegal, or is it this whole thing of he has other venues to impose tariffs? So either way, it's not as eventful.
Yeah, so there's really two ways of thinking of the corporate reaction to this. The first is the refunds. Now, there's about $150 billion that would be refunded from this. Don't expect the court decision to say you must refund. It's going to get thrown back to the lower courts, and there's going to be a process, and it's not going to be quick. It's going to take time. So if you're a company and you're looking at a company and you're hoping that these refunds will come quick, it's probably not going to come all that quick. The second thing is, what is President Trump's reaction? Now, just this morning, Kevin Hassett said, look, we're most likely going to go to a 10% tariff. There are tools that President Trump can implement immediately, but you're looking at a 10 to 15% tariff rate, and there are some restrictions. Like, for one, you can only go to 150 days. Then you're going to start hearing things like Section 232, Section 301. What you need to know is investigations take time. And ultimately, will President Trump want to put that back on the American populace?
All right. We got to wrap it up here. You joining Joe today, Nathan? Are you joining Joe?
Yeah, I am.
All right, Nathan Dean of Bloomberg Intelligence. If you didn't get enough from him here, you can hear him more on Balance of Power. That starts at noon on Bloomberg Radio, 1 o'clock on Bloomberg Television. That does it for us. Have a great weekend. This is Bloomberg.